I'm Keith McCullough, and welcome back to another real conversation. This one again with Jim Bianco. Jim, we had a great discussion this summer where you, I think, caught some people off guard by your bullishness. Again, awesome call. I mean, I don't think you're known as a permabull, by the way. In fact, maybe one of the furthest guys from it. But that really was a moment in time where there weren't many people like you who have been bearish plenty of times in his career where you're a rip-roaring bullish. Congrats on that.
Well, thanks. Yeah, it was, an interesting period. Everything in 2020 was unusual about the way that the markets traded. So you did get unusual calls too.
Yeah, I mean, can you walk through that a little bit? Because I think, there's so many people. Actually, there's a company that's going to come public today that literally sells fear-mongering research. I mean, there are companies out there that are in the business of marketing certain asset classes, obviously, because they get paid a fee on it. And there are people that are in the business of marketing one-way bearishness or one-way bullishness. Like, how do you deal with that, and how do you think about that? You've been at this for a long time.
Yeah, you do tend to get pigeonholed into a certain type of genre that you're a perma-bull or you're a perma-bear, and everybody thinks that your opinion is a religion, and I'd like to say that, my opinion is a rental. And I can rent it for a week or I can rent it for 10 years. It depends on the way I want to see it. And I always try to say that half of what I try to do is say, which direction do I think the market's going to go? And the other half of what I do is maybe evangelize on what's going on in the world, but try to keep those separate. Yeah, we could be printing too much money and doing things that I think are reckless, which is what I was saying last summer, but we're going to go up, which is what I was also saying last summer. And you don't want to say, oh, we're printing too much money, we're being reckless, so therefore moralize and say, the market must go down, and not recognize that this might work for a while. And that was kind of what was behind my bullishness last summer.
I think that's a great word, moralizing, or recently I've just hashtag belief systems. That really is what you have to play against. Do you find that to be with this newfound world of yours? And by the way, I think that a lot of people on Twitter say, hey, wow, this guy's like a man of the people. Chicago guy, he's not like one of these people up in an ivory tower and he doesn't take himself so seriously, but you actually reply to people and with respect. Like, what is it about this environment, that allows you to go both ways, and maybe a little bit more so than you have over the course of your whole career? You've been doing it, like I said, for a long time.
Yeah, I've been doing it for way too long. I think that there's two things. I think the seat I sit in is, I'm an independent research firm, kind of like you are. I'm not beholden to a trading desk. Although I'm affiliated with a brokerage firm, they don't carry positions. So I don't have to be saying something and then listen to the guy say, hey, we've got a long position here and you're talking it down. There's none of that like there is on Wall Street as well. We got no investment banking. Don't badmouth them because they won't do business with us and stuff. So I got that freedom to do it. And I've also got the freedom, when you say that, I've been doing this long enough that I've been hammered enough with bad calls to know that there's nothing absolute about what you say. So don't take yourself so seriously. Yes, I have an opinion. I think it's going to happen, but I've had opinions in the past and they haven't worked out. So I'm not going to get myself that enamored or wrapped up into my opinion that it has to work out and stammer my feet and say, why isn't it working? It has to work and stuff. I did that earlier in my career, many decades ago, and I've learned from it.
Well, I think that's quite it. I don't know if we're the exact same age, but we definitely have, you have 4 girls, I have 3. Again, we'll always highlight them over my son. But at the end of the day, it's not our first rodeo. We've screwed up, publicly many ways. In fact, probably more ways than most people have been able to. And for me, at least, that's how I think I learned how to be bullish in a bubble. I mean, it's because I learned that the last time or however many other times that we've had these types of experiences that I was not doing what I should be doing, which is making money in a bubble. And by the way, one of the best quotes that I've read from you in a while, or from anybody for that matter, is just about that. You said, the great thing about a mania is that you make a lot of money fast.
Yep. You do. You make a lot of money real fast, but it can be a roach motel. The problem with the mania is you have to know when to get out. And what last spring taught us was, or at least it's going to teach a lot of people with the mania is, oh, if you lose a third of your money in 6 weeks, don't panic. Just stick with it. And then that becomes permanently half your money is gone. And you go, what the hell just happened? I was on the top of the world and everything fell apart. That's what I mean by you can make a lot of money real fast in a mania, but keeping it is the trick, not making it. Because do you get chased out by a 10% correction like we had in September?
Mm-hmm.
No, because then it comes right back. Or a 30% correction like we had last March? No, it comes back. So how do you know when to get out? And if you don't, you just wind up with this gigantic round trip. And that's going to be the hardest part about this. It's not being bullish on the up. It's when it's time to pull the plug. That's going to be where you really get paid.
Yeah, I mean, I think guys from Chicago sound like the Canadian to me. I mean, who gets you out? I mean, at the end of the day, that's a big question in risk management. And to me, one of the biggest bubbles was the inflation expectation or the deflation expectation at the lows of interest rates. I mean, there are a lot of different kinds of bubbles. I don't think that's the one that people typically had been worried about, or the gold, maybe not a bubble, but certainly one hell of a move to be not chasing back in August. This interest rate bubble, do you agree with that or not, that we were in a bubble of deflationary expectations?
I do agree that we're in a bubble, that interest rates are overvalued because you've got a non-price sensitive buyer with a printing press that's been buying these things. But that said, that's been the state of affairs for the bond market for 12 years now.
Right.
So it's not to say that it is a bubble. It has been that way for so long that we almost forgot what it was like to not be that way. And the real question is when does it go too far? And when do we have a problem in the bond market? And I think that's coming a lot quicker than everybody thinks, like maybe later this year. I think what we saw last week in the bond market is the beginning of a lot more problems in the bond market as we go forward from here. And for those that are not in the bond market, I want to quote Jim Carville from 1994, that when I get reincarnated, I don't want to be a 400 hitter. I want to be the bond market because you could scare the hell out of everybody. If the bond market has a problem, everybody in finance has a problem. And that could be something that we could be looking for towards, in the second half of this year.
Now, if you go, agreed, but not all bond market problems are the same. Like, so if we go back to the bond market problem, let's go backwards in chronological order, that were a lot of head fakes. Being short bonds was a great position. Being short gold was a great position because it's one and the same thing in terms of real rates. But 2013, 1999, 1994, like all three of those times was not a time to say, oh my God, I got to sell end of the world newsletters because bond yields are going up.
Right, exactly. And you could also throw 2009 in there too.
The bond market, 2009, yeah.
Tremendously bad year as well. So it is, and this gets back to that moralizing thing as well. Oh yeah, is it wrong for the Fed to be printing money and buying bonds? Yes. But I don't want to, I'll only moralize on it to a point and say, there's a tidal wave of $100 bills coming at me, and that's going to matter. And do I want to surf that, or do I want to stand there with my hand up saying stop? And that's the problem that I think people have to recognize when it comes to a lot of this stuff, that the bond market is being driven by the Fed. That is the state of affairs. And only when we get to what I've been arguing is inflation to the point where it's unsustainable, and I think that might be coming a lot sooner than people think, then does it become a real problem on its hands. It's not right now, but we might be starting to see the beginnings of it, especially with what we saw in the bond market last week.
Well, if you model it the way that I do, like my call's been that it's going to happen like all things in risk space. It happens slowly, then it happens all at once, like all breakouts in growth and or inflation. In this case, we have both, which I call quad 2. It's mathematically impossible to not have higher levels faster of inflation in the months of March, April, and May due to the base effects, which are the most deflationary base effects. Obviously, you know what base effects are. Hopefully everybody watching this knows what that means. But even if you don't have sustainable inflation, our view has been that you're going to have shockingly high headline inflation for all the bureaucrats and all the Fed watchers and all their cover-your-ass institutions that are going to be looking at these high inflation prints.
Yeah, you are going to get high inflation numbers, in the next 90 days. It is the base effect. That's because in March and April of last year, when everything was shut down, nobody was buying anything and prices plummeted. Well, we're going to roll that off in March of April of this year. And the 9-month annualized rate of the core inflation rate right now, PCE, the Fed's favorite measure, is 2.5%. 9 months being since May, since the shutdowns. So you're probably going to see it shoot up the core inflation rates from about 1.7 to 2.5% in the next 90 days. Everybody knows it. And what I've said is this is the built-in excuse for why any signs of inflation will be dismissed. But let me make a quick comment about inflation so everybody knows where my thinking is on this. The highest level in the last 28 years for core inflation, core PCE inflation, has been 2.55%.
Right.
I'm saying that we're going to go to 2.6. And then people go, 2.6, that's not inflation. I'm like, no, well, first of all, it's a 28-year high. Let's start with that. So don't confuse me with saying that we're going to rerun Zimbabwe or even the late 70s. Let's start with 2.6. Then if you get to that level, and you will in the next 90 days, but then everybody expects it'll fall off after that. But I don't think it will. And if you stay at that level and interest rates go to positive real yields, now you're looking at a 3% long bond. Or I'm sorry, a 3% 10-year note, probably about a 3.5% long bond. I think that will cause a lot of consternation in the bond market. There's a lot of leverage players in the bond market, a lot of hedge funds in the bond market. Great thing about the bond market is it allows you unlimited leverage. Call up a dealer and buy $1 billion worth of 5-year notes. Well, okay, you need $1 billion to buy it? No, you don't. You can finance the whole thing on infinite leverage. Well, if you get rates to start to rise to 3%, those losses will hurt. And that will cause a lot of problems in the bond market. And that's why I'm saying if the bond market has, problems, everybody else will have problems as well, too. So, yes, I think that we're going to see inflation, but I'm not calling for massive inflation. I'm just 2.5%. And the last thing about 2.5%, you see Rich Clare to the Fed, you see Jay Powell of the Fed say, oh, we've got this new average inflation target regime where we've been under 2% for a long time. We'll let it run hot above 2%, maybe as high as 2.5%. So even if we get to 2.6, we're fine with it, is what the Fed says. My argument has always been, it's not the Fed's call, it's the market's call. If the market is not fine with it, then the Fed's got a problem. If the market's fine with it, then the Fed's fine with it. And I think the market will find a sustained 2.5% level to be something that's going to be problematic for them as they move forward.
Well, if you go back to the periods where the market's been fine with it, I'm assuming you're defining that as the stock market being fine with what the bond market's doing, correct? Right. And it is important to include 2009 because, like in my model, the years where we were rip-roaring bullish on growth as a factor exposure again and inflation were 09 and 2013, and I wasn't like, this isn't going to derail me from buying the damn dip. If you can't buy the dip because interest rates are going up, you're not selling the rips because interest rates are going up. You're missing the whole point. 2009, 2013, just to use those very obvious examples, because I have all my timestamps on them, I think it still like shook people. People spent the whole year whining and crying and complaining about interest rates going up, therefore stocks should not. Now, not all kinds of stocks should. I mean, for example, utilities, consumer staples, bond proxies have been awesome shorts. But certainly the things that work in what we call quad 2 can work. Quad 2 is when both growth and inflation is going up at the same time. What do you think about that?
Yeah, I'm in complete agreement. The way I've tried to delineate it is there's R for reflation or real growth, and there's I for inflation. Mm-hmm. If the reason yields are going up is because you're getting reflation or real growth, stocks are fine with that. That's what they want. They want more earnings. They want higher standards of living and everything else. And right now, everybody thinks it's R, reflation or real growth, that's driving yields up. But if it becomes I, inflation, that's less purchasing power. Your dollar buys less in a year than it does now. And you're buying a fixed income security, as the name says. It's not what you want to own when you get I, inflation. Now, we haven't seen inflation to any great degree for 25 years. It was really the early 90s was the last real inflation that we saw at some point. We got four handles on core inflation and stuff. So a lot of people have forgotten it. They think automatically, Wall Street automatically thinks that higher rates is a time to you break out and God bless America. It means everything is great, is what it means. And that they forgot that there can be another side to that, and that can be the inflation side. And that's what I'm worried about after the base effects. Yes, we know in the next 90 days, the inflation rates are going to go up. No one will pay attention to it. And I'll tell you, it will start to go right down after that, somewhere in the summer or the fall. But if it doesn't, that's when I think we're going to start to see those worries. And again, I'm only talking about 2.5%. I'm not talking about some massively large number as we move forward from here.
Yeah, that's the that's actually the conundrum of the 1970s, is that it just wouldn't go away. So your cyclical inflation, like there have been so many times to make money being long inflation. Like I always say to people, like instead of whining about it, why aren't you long it? Like being long commodities since June of last year was awesome. And it continues to be awesome, and it's an under-owned asset class, et cetera, et cetera. But once we get into stagflation, if it's protracted, I think that's what you're saying, like what I call quad 3. Real growth is starting to slow. Inflation's running, annoyingly high or stubbornly high, or for people that don't have any money or a job to begin with, really at a level that they can't sustain themselves. That's a really damning position for all markets. I mean, the 1970s, how many people on Twitter invested through that period?
None. Yeah, exactly. I think it's also important to throw out why I think inflation is going to come back. And I've been using the argument. People have been saying, well, how can you have inflation if you don't have wage inflation?
Right.
The answer is write it larger to personal income, because a big part of personal income is wages. And what we're seeing, what we saw last week with the personal income numbers, is the United States, everybody, all of us collectively make about $8 trillion in personal income. Most of that is wages. 25% of that number now is coming from the government mailing us money. That is far and away the highest number we've ever seen. Pre-pandemic, I think the highest it ever got to was 9%. Well, not only is that disability and Social Security and unemployment insurance, but it's extra federal benefits of unemployment insurance. It's the stimulus checks that we keep mailing out and everything else. 1/4 of all of the money income that we've made is from the government sending it to us. And they're about to send us another $1,400 check. So I said, we're having personal income inflation. And that's what's been really driving this. We've got the savings rate up to around 20% right now, which is unbelievably high relative to pre-pandemic. So we've got all this money we're sending to people. And if we get enough jabs in our arms and we start feeling better about things and things start to open up, I'm in Chicago, I get to go back to Wrigley Field, the whole 9 yards. We got money and we're going to spend it. And that's where your 2.5% inflation comes from, at least initially. And if the bond market sniffs that out, I think that the bond market will have a problem with that as well, too. Right now, we all think that all that money that we're spending, we get those $900 checks and the $1,400 checks. What we think is happening with it now is we put it in our Robinhood account and we wait for Davey Day Trader to tell us what to do with it. That has been the case for a number of months. But going forward from here, I'm not so sure that that will be the case. We're going to be looking to raise our standard of living. It's nice to have a nice number in my Robinhood account, but I would rather have a car, or I would rather have some new clothes or something along those, or have a vacation. So that's where I think that we're going to get the big spurge of spending that could lead to higher prices.
As is always the case with Jim Bianco, almost every word that just came out of his mouth is an empirical fact. How about that? Like, how many people can I say that about? Guys, let's just show slides on everything that Jim just said in a very short period of time. Do slide 79 first. This is exactly what he means by this. This is showing household spending expectations, Jim, which you're very familiar with, I'm sure, is at a 4-year high. The next chart shows the pent-up nature of all this, slide 80, which shows the buckets, U.S. benefits, stimulus payments, PPP, fully loaded, over $1 trillion in disposable income, with this setup, like you said, on 82, which is savings. This savings, and again, newsflash, Americans, it's unnatural for them to save. They want to spend, at Wrigley Field or not. So at the end of the day, this is, that's the thing, is that we have this, what you just said, Jim, and thanks for saying it. And I wish more people, when they spoke, were held to account in terms of like, what is actually coming out of your mouth? Like, is it like a belief system? Are you evangelizing, moralizing, et cetera? Or is what you just said just a series of time series? That's just charts, and what you said absolutely is. So to me, it's actually humanly impossible to answer the question. Like, as all this comes out, this is the mother of all, like in my world, in fractal space, it's the mother of all points of entropy, where you get all this just comes at once. And no human being can, nail that power law, because you have to watch it behave. So to me, I spend a lot of time telling clients that, like, I don't know how this is going to end, but when we're in it, we know why, and it could be a lot bigger to the upside than what you think.
Yeah, exactly. And, one other takeaway to keep in mind is a lot of economists, when you hear that argument to me, would say, yeah, but that's a one-time thing. So we'll just get this big splurge and then it'll go away. And that's true, except I've said, look, we sent out $1,200 checks last spring. We sent out $900 checks in January. We're going to send out $1,400 checks. If there is no consequence to these checks, and all you're going to tell me is, oh yeah, we mailed people a bunch of money, and the poor got some assistance, which is good. The unemployed got a bridge, which is good. And the rich, and let's define the rich as people that own assets like stocks, they saw higher prices. If you're going to tell me everybody won because we mailed out checks, we're going to mail out more checks. We're just going to keep mailing them out and mailing them out and mailing them out. And if there's no consequence, then why would you stop doing it as well too? And that's why I think ultimately one of the big consequences is inflation. If you just keep sending this stuff out, we're going to get more. And what do I mean by that? Look at they're going to send out $1,400 checks in the $1.9 trillion stimulus plan. And then what are they going to do? They're going to take a breath, and they're going to start on a multi-trillion-dollar infrastructure plan.
Yeah.
And then you've got Mitt Romney, a Republican, saying, hey, everybody who's got a kid under the age of 17, we should be sending you monthly checks as well, too. Up to $5,000 a kid is what we're talking about sending people that. Boy, if this doesn't, like I said, if this doesn't produce inflation, then the MMT UBI people, the modern monetary theory, universal basic income people, were right. I don't need a job. Just have the government pay me money is really what we're going to do from there.
Let's spend a little bit of time on that before we take questions. If you have questions for Jim, pop them in the queue. They get voted up and voted down. But on the central banking role, and I know you have a lot of thoughts on MMT. You just teased me with that. But like, I like to posit. Okay, look. Let's say that we don't have inflation sustained. We get what we call quad 4 deflation from a very asymmetric point. So I have headline CPI going north of 3.1%, or that's what our nowcast is, guys. You can show that on slide 15 in our deck or in our model. If we get deflation from there, Jim, if there's no sustainability, it's not 2.5, it's not 2, it's going back towards 0. Mm-hmm. If that happens, is there any other thing that the U.S. government and all of its new architecture, fully loaded with modern monetary theory, is going to do other than what you just said, which is print more and more and more money? So in other words, if you get any deflationary forces, and that's gonna be the solution. Is there any other solution? Do they have any other solution?
No. All they've got is a printing press, and all they've got is a little dial on it as to what speed they run it at. If you get your quad 4 deflation, they'll put it at 11 is what they'll do, and they'll see what and we'll go from there. By the way, Spinal Tap is a fantastic movie if anybody hasn't seen it. And so that's what they'll do at that point. The only thing that would stop them then is kind of what I said before about 2.5% inflation, is if the market rejected it. Right. If the market decided that if they're going to try and go to 11 with their printing. And by the way, if you want an example of that in the last week, look at what's happened in Australia, because their rates started up and they have yield curve control, and their central bank blew away every one of their bond buying records in the last 3 or 4 days to try and bring rates down. For the moment, it's working. But at some point, if investors say, look, if they're just going to keep printing money like this, I don't want to be anywhere near this market, then that's their end game at that point. They've got no other tools, because all they can do is just be easy. And if the market doesn't like it, it would be a problem. Now we're ways away from that right now, but you're right. That's all they've got. They've got one tool and it's got a little knob on it, and they just, what speed are they going to run it at?
Turn it to 11. Well, yeah, and the Australian example is awesome, and thanks for popping that on the table too. And again, how many people actually look at risk across asset classes and globally? Thanks for doing that. Obviously, you've done that for a long time. But what did the Australians really achieve? I mean, in the last month alone, the 10-year yield's up 55 basis points. They got it to go down 5 basis points. I mean, the same thing happened in the USA without the same kind of bond buying. It's what happens, like I say, from the top end of the range in a bond yield move is, yeah, they correct, but bond yields have not broken down. This is not like they have it uniquely under control. I'd say that their problems have been revealed and that they're going to have to do a heck of a lot more of that.
Right. The Australian thing is important because they have yield curve control. They stated as in November that their 3-year yield is going to be pegged at 10 basis points.
Right.
They're going to hold it right there at 10. Well, it started to move up to 17 basis points. That's a big deal when you're trying to peg it at 10. So they've been printing up money and buying the 3-year note to try and force it back down to 10 basis points. And they're getting there right now. And their 10-year yield, as you're right, had been soaring at the same time that their 3-year yield had been moving up.
Yep.
The message there is, if you listen to bond people in the United States, oh, don't worry about rising rates because the Fed will print money. And if it gets to be too much, they'll do yield curve control, which is where they just say, okay, they'll give a target for a specific interest rate. Well, they're doing that in Australia right now. And Australia's a commodity resource country. And, we all know commodity prices are going up. And they're really got their hands full to try and hold that market in place. So don't think that yield curve control is this panacea that will fix everything. What do I think is the reason they're having a hard time with it? Because they're worried in Australia, as they are in other places, that it's not just reflation that's expanding their economy, that it might be inflation. And I don't want to own a 10 basis point or 17 basis point 3-year note if we're having higher inflation. Mm-hmm. And I don't care if you're going to print money and buy it, you're going to have to own the whole thing without me being the private sector. And that's really what they're not at yet, but they're getting closer to in terms of it. I've used this analogy that central banks are like a post in the ground and the market is like an 1,100-pound horse tethered to that post, and it stands there and doesn't do anything. But when it gets spooked, and inflation is the way you spook it, it'll rip the post right out of the ground and go wherever it wants to go. And that's what the central banks have to be very careful of, is that when the market gets spooked, whether it's inflation or deflation or whatever bothers it, whatever plan you have will get ripped right out of the ground, and it is done at that. We've seen it many times.
That's a great metaphor, analogy, et cetera. I mean, think of, because what I pointed out on Aussie rates was the 10-year. That's the long end, of course. The short end of the curve is that horse's post. If you can't keep the short end, again, whatever you want to call it, yield curve control or just anchored there, that's actually, if you look at it, just for all of you that can obviously overlay one chart against another, overlay the VIX against the 2-year bond yield in the U.S. When the short end moved last week, people are like, oh shit, that horse ain't allowed to run. and then all of a sudden, bang, the 2-year yield comes back to like 13 basis points today, and it's off to the races, yesterday, obviously as a function of that. So isn't that just it? Like, if you promise me to keep the horse here, I'm good. And if the horse just goes on its own, then it's left and we can't bring it back.
Right. To put it in U.S. terms, if the Fed is promising that they're going to keep rates low and you believe that promise, let's ask a basic question. Who buys a 2-year note that yields 13 basis points in the United States? It's not a money fund because they can only buy out to 1 year. So who buys this thing? Why would you buy this thing? And the marginal buyer is something like a hedge fund. Like I said, you buy $1 billion of it and you call up the repo desk and you get a 13 basis point yield, and the repo desk tells you it costs 5 basis points to finance it. Boy, that's 7 basis points on $1 billion, and I put no money down. Yeah. That's pretty damn good. Except if you then get into a period where you think, holy crap, the Fed can't control that 13 basis points, and it might run to 25 or 30, and I'll be saddled with a giant loss if that happens, because I'm working on such extreme leverage. And then you sell, and then it turns into a rout because everybody wants to get out for exactly the same reason. That's the problem with the moral hazard that they've created with all these policies that we're going to keep rates stable, we're going to keep them low, Okay, fine. Then I'll buy them with no money. I'll just finance the whole thing and just sit there and watch my cash flow roll in because you've guaranteed me these prices aren't going to move. And if I have doubt about the confidence that you can keep those prices moving, I am so much risk if the prices start to fall that everybody runs out at the same time. And that's how you wind up having these debacles like 1994 is the big one in the bond market over and over again. So they've got it. That's why the Australian example is so important, because believe me, the same thing's going on in Australia too. Who buys a 10 basis point 3-year note in Australia? Some Australian hedge fund on leverage, because they've been promised it's not going to move in price and they can finance it for lower and make all that spread. But when it starts moving, they get very, very worried because their assumptions are being challenged.
Yeah, of course. I mean, and the stability of the assumption, which is, you can see it in the MOVE index, which has got shorter dated treasuries. For those of you that don't know what the MOVE is, it's like the VIX of the bond market. The MOVE went to like 75 last week in a New York minute, and that's what really got people the attention. If the Fed cannot control the short end of the curve, then you got a problem. If the short end stays marked to where it's been, or there's yield curve control or whatever you call it, and the curve continues to steepen, for the financials in particular, that's awesome. And these are terrible businesses that need it. I mean, these are rate sensitive and curve sensitive businesses and stocks. I mean, it's not. I don't think that this is lost on people. Like the move in bond yields didn't start like last week. A short-term move in the short end of the curve happened last week. Very different than what's been happening really since October, November. Bond yields have been going up. It's very obvious.
Yeah, I mean, bond yields have been going up. What happened last week is it got a little bit chaotic. And you hear a lot of people on Wall Street say, oh, it's not that rates are going up. It's just the speed that rates are going to go up. As long as rates go up slowly, everything's okay. Well, why would they go up slowly? What you're saying is bond investors are going to just sit there and watch them lose money and lose money and lose money. And one by one, they're all going to sell at various times in a very orderly fashion. Or are they all going to come to the conclusion, like last week at the same time, that this is not a good place to be. Let's all get the hell out of here. And then you wind up with what you saw with bond yields do last Wednesday through Friday as well, too. That is where the confidence in the central bank comes in. That's why I said, I can moralize about all the Fed buying for the last 12 years, that they've been buying. What's made it work is that people have confidence that it's going to work and they'll play along. But as soon as they lose their confidence in the central bank to be able to control the rates at the rate and level that they say, then it's time to exit. And that's where you can wind up seeing things get very, very messy. And again, any kind of surprise with inflation, I think, can cause that confidence to be questioned in the central bank, as we saw in Australia last week, and maybe it might be close to being seen. Let me throw out another country for you, Japan.
Yeah.
They instituted yield curve control in 2016 at 0. They said, we're going to hold our 10-year at 0 in 2016. It's at 16 or 17 basis points now. That doesn't sound like a lot, but it's the highest it's been since they instituted yield curve control 4 years ago. So now the question is with Japan, well, if you said 0 and rates are going up to the highest level in 4 years at 17 basis points, does 0 still apply? Should I be running away from this market? Or are you going to keep to your word and push it back to 0? Because I have bought these bonds under some kind of an assumption that they're going to be near 0. Remember, yields go up, prices go down. Not that I'm going to be taking losses. I'm not supposed to be taking losses. Otherwise, I don't want to be anywhere near this market if I'm going to be taking losses. When you promised me I wouldn't be taking losses. So Japan's another country that's getting, they're not there yet, but they're, to use my metaphor, the horse hasn't ripped the post out of the ground, but it's pulling at it a little bit right now. And we'll have to see whether or not the post holds, or if the market continues to pull at it and winds up ripping it all to shreds and starts running all over the place.
Yeah, I mean, another way to think about that is through the lens of the currency market. So when the post's out of the hole, the currency, people were betting, and now, at least on my signal for the first time in a while, the yen broke down versus the dollar. And that's just an explicit bet that to get the post back in the ground, the Japanese have to do more of what they've been doing forever, which is print, more. I mean, forget 11. Those guys are at like 21 on a 10 dial. I mean, that's that.
dial. They got a second dial that they had to bring in.
They have other dials. Well, that's the thing about MMT. You just keep creating more optionality in terms of people's, I think, what did Bernanke call it? Innovation and creativity, or some of his fans call it that. It is quite interesting, to watch. Last question I have on all this, I think it is interconnected, is drawdowns. I mean, you can be having a drawdown in long dated bonds, which obviously a lot of people are having right now. A lot of pension portfolios. You saw, I don't know if you saw, but Bloomberg had an article on that today. Pension fund managers saying the market's got it wrong. No, in other words, you, Mr. Pension Fund Manager, completely missed this, and you just got your ass handed to you, so you're going to say that the market's got it wrong. That's kind of sad, actually, I think, for pensioners, because they have to eat this rising cost of living, and their pensions aren't going up in kind if they're not actually capitalizing on the rate of change of inflation. But there's not just that. There's drawdowns in the hedge fund community on certain style factors, high short interest stocks, crowded longs. Momentum was the biggest thing last week, where momentum stocks, widely owned momentum stocks that also had low short interest and low beta, got pounded. Is all this one and the same thing? Like what I see in the market, because I think this has been a great start to the year and a huge run since November. Like I don't have their issues, and I don't purport to want to carry their baggage or their issues. To me, their issues are one and the same thing. You should not be short high short interest stocks in a bubble, a developing bubble, and whining about it because it's a bubble. You should not be long bonds and gold in a rising interest rate environment, and you certainly shouldn't be long a bunch of low beta stocks like Amazon and Apple that everybody and their brother, sister's brother, who are all related, own. I mean, these are issues, I think, of crowding and drawdowns, not issues of economic matters.
Absolutely. At its heart, every move on Wall Street starts with a very true and simple to understand idea. This one really got going November 9th. That was vaccine announcement day, November 9th, a couple days after the election, when the vaccine came. Okay, good. Here comes a vaccine. Everybody's going to get inoculated. We're going to get back to some sort of new normal or some version of normal, but we're not going to just be in this perpetual lockdown stuff. Right. Okay, good. You're right. Growth is going to go higher. Things are going to get better. Stocks should go up. But what Wall Street does is they take that truism and then bend it all out of shape and take it way too far, is what they do. Now, part of the reason that they're bending it out of shape and taking it way too far, I believe, is while we're recovering and everything's getting better, oh yeah, we're going to keep mailing you money, and we're going to keep printing money and buying everything as well too. So you wind up getting everything to go. And you're exactly right. If that's the environment you're in, you don't want to be short some company that's 140% of its float. You don't want to be fighting against some of the cyclical stocks when you've been saying, oh no, this is the new paradigm, and that that technology companies are going to rule the world. That might be true long term, but right now those cyclical stocks are going to keep going because we're just putting this whole story about the vaccine and the reopening on steroids with all of the stimulus and with all of the money printing. And again, this gets back to what we started with at the beginning. Stop evangelizing and understand what the trend is and just go with the trend. Yeah. By the nature of the way I said it, I don't think it's a good idea what we're doing, but it's what we're doing. And that's what I want to try and jump on, is what we're doing, instead of just standing there and moralizing about it.
Yeah, that took me too long. Took me a long time to stop. And I think it's endemic to where I grew up in this business, which is as a hedge fund analyst and then a PM who was too young to do that job in my early 30s because I hadn't seen enough cycles. People they stick to their models, their valuation, the way that most of my bosses, the way that the world should be, as opposed to risk managing the world we're in. And that is such like an eye-opening and liberating way to look at markets, Jim. So thanks for saying that. I mean, I think it takes guys, crustier older guys like you and I to just make enough mistakes and just not want to take it anymore. I mean, it doesn't work.
I've said to people, if you really want to understand this business, become a fan of baseball. Because in baseball, if you fail 7 out of 10 times, you go to the Hall of Fame. And that's kind of what this business is about, is that you just got to succeed more than you fail, but you're going to fail a lot. This is not free throw shooting where you want to be 96% and lead the league, because you're never going to be that. Well, if you ever are 96%, you're going to be ahead of Elon Musk in net worth anyway. So let's not, pretend that it's going to be anything other than that. So this is about a lot about that. And if I could go off on a quick tangent, one of the things that I like the best about what's going on on Reddit, which I think is something that Wall Street could use, is they call it loss porn. And that basically what they say is, don't come out here and brag about your winners. Show me the trade tickets of some of your losers. And we're going to celebrate that you made a bad trade. If we did more of that on Wall Street, just to understand, you do that. You make bad trades. You lose money on stuff. The idea, that's not the thing to obsess about or hide. Oh, he's very smart. He never loses money ever. No, you do all the time. You just want to win more than you lose. And if we did more of that on Wall Street, that loss porn thing, I think we'd all be better off. All the younger managers would be a little bit better off, because I think the mistake that they make is that they think that they have to be perfect. And you don't have to be perfect in this business.
Not even close. I mean, we've had so many discussions here about that. I mean, Mike Taylor, for example, longstanding hedge fund guy at Millennium, he always says, he's like, look, the guys and gals that get fired here, they generally just make the same mistakes. They just don't listen to the market. They think they're smarter than the market. And what's interesting about it on Wall Street versus Reddit, and I'm not trying to downgrade Reddit, I think there's brilliance in chaos, and there are a lot of really smart people there. And it's not about being smart like in a textbook, it's about being street smart. Can you make more money over time than you lose? Can you avoid drawdowns? Can you understand when to get out? These are basic things. And I do think it's interesting to watch the collision between these two communities. You talked about this in July with me, and I think at the end of the day, I've been happy to see it, the retail participation through the lens of Portnoy. And he always talks about his losses. He always talks, and they're real dollars. And I think that really gets his community to trust him. Is it, I lose money, I get pissed off, and he goes after people too, which is kind of great. But you don't hear that from some guy, you hear some person at Goldman Sachs talking about how they totally got bond yields and gold wrong this year. Never. Actually, Goldman would never be bullish on gold, so maybe a bad example. But anyway.
No, you're right. They never talk about it, and it's almost verboten, because somehow they think that if you admit that you got something wrong, that you wind up, denigrating yourself. No, I think, to be honest with you, I think the bullshit that you always are right all the time, that to me is what strains credibility. I'm fine with somebody missing something. I miss something, you miss something. We're going to miss stuff in the future. This is a tough business. We're predicting the future. No one knows it. It hasn't happened yet. And so it's a lot like, I think a lot of people need to have, to use another sports analogy, the shooter mentality. You give the ball to a basketball shooter and he takes a shot, he misses, and his first instinct is give it to me again. I don't care. I don't care, because that's what happens here. Just give it to me again. And that's kind of where I think people are. But in this business, they take a shot and they lose and they miss, and then they crawl into the fetal position and start crying and moaning, and then they convince themselves they actually made the shot. Is what they wind up doing, and it just doesn't help anybody to do that.
It doesn't work. It's not the real world. I mean, I'll go to, because you haven't used a hockey analogy yet, I might as well use one of my favorite ones. Wayne Gretzky. You're going to miss 100% of the shots you don't take. 100.
Right.
That's the only certain thing that you have in your life. That's it. 100% of the shots you don't take. And at the end of the day, I think that a lot of the problems in the hedge fund community, like I hate to tell them, particularly if they're a younger analyst that never had anything wrong on a test in their life. When they get something wrong in the real market, it's not unlike baseball or hockey. You get punched in the face in hockey, and it's real, and you could lose your teeth, and there's no whining. There's no whining to the to your mommy. There's no whining in that's baseball. There's no whining in baseball. No crying in baseball either, according to our friend Tom Hanks. Let's go to I got to ask some of these questions.
One of the questions I just want to say real quick. I think that's one of the reasons why people that have engaged in sports a lot do well in this business. And I'm talking about men and women, because one of the things about sports is it's about whether you play tennis like my daughters do, or hockey like your son does, or you did. It's about problem solving. It's not about perfection all the time. You're out there and you're making mistakes, and you got to stop making the mistakes, and you got to figure out what works and stop doing what doesn't work, whether you're on the tennis court or the hockey arena, the baseball arena, or the swimming pool, or wherever you are. And that's why I think a lot of people that have been successful at sports, because what makes you successful at sports is largely problem solving, figuring out what works and do that, and figuring out what doesn't work and stop doing that. And that's a large part of what this business is about.
100%, and that's go right back to the beginning of the discussion. The difference between you and I and them, let's just park them as belief systems or people that are giving you some evangelical view with an asset management fee or a marketing pitch. It's just not the same thing. It's not back check, forecheck, paycheck. It's either back check, or forecheck, forecheck. And that's just not, that's not what you and I are doing. And I do think that we're helping with the education of a new class of investors, not like societal class, just like literally new in terms of they've never done it before. And I know that a lot of them are watching and a lot of them are learning. I'm finding that a lot of our individual subscribers, RAs, family offices, et cetera, they're doing a lot better than a lot of people that are dogmatic, that are only doing the one-way thing without any kind of evolution or any kind of flexibility in what they do to get onto the right side of the trade. So thanks for helping all those people out there with that. This first question, Jim, has to do with what you and I already alluded to. I knew that this was going to trigger people, but if we do get deflation, or what I would call quad 4 in the back half of the year, what policy mistake do you think that the Fed can make a policy mistake that could create a market meltdown, if any?
Yeah, I think if I was wrong, we wind up getting deflation, or we wind up getting seriously, falling inflation. I don't know if we go all the way to zero. The mistake will be is that they'll think that we need to do more of the same. It'll be another $2 or $3 trillion fiscal package. More checks will be sent out. The Fed will be continuing to try and ease, because what they want is they want the economy to go back to 2019. Well, it will go to some version of it over time once we get past the pandemic, but they want it to be there now as well. So that's what I think the mistake will be, is that they'll just do more of the same. If we get deflation, if we get falling prices in a struggling economy, their conclusion is not going to be, we sent out 3 checks and we've done what we can. Good luck to them. They're going to send out more, is what they're going to wind up doing. And that could create a whole host of problems in and of itself as well, too. So we'll see what the reaction will be.
Yeah, the second question, James from San Antonio, it's essentially the same type of question. With the implication, Jim, historically the Fed continues on their path until they break something. What do you believe the Fed will break this time and cause bigger problems going forward?
Yeah, that is true, is that every time the Fed raises rates, they go too far and then something breaks. The last time was 2019. They hiked the funds rate to 2.5%, inverted the yield curve, and then the repo market broke in September of 2019. This point along, bear in mind that the Fed is not raising rates on the front end. It's on the back end. Will the market raise rates enough that something will break? And that is a fear. And I think what they're going to break is they're going to break the private investor in the bond market, is what they're going to do. And then the bond market will have to rely even more on the central bank to support the market. But my horse post analogy, I don't think there's enough central bank to handle the market without the private investor. You talked about that Bloomberg story. I saw it too, about the pension manager that said that the market is wrong. Do you know if you own 30-year bonds, that year to date, you're down 17% year to date? That hurts. That really hurts.
I believe, Mark.
Yeah, I understand that if you hold them long enough, they mature at par and stuff like that. But you've got, as a pension manager, you've got to meet a hurdle rate every year in terms of meeting your obligations. And if you fall behind a couple of years because you had a bad couple of years in the bond market and lost 17% on the long end, you're really cooked, and your pension fund becomes underfunded, and it becomes a real problem as well too.
I can't imagine somebody running real money, that kind of money in this day and age, that doesn't have to succumb to the secret to the universe or calculus. The rate of change of inflation, just blatantly ignoring it at this point. I mean, it just doesn't make sense. I could see in pre-1999 internet, no Reddit, no Twitter, no transparency, nobody gets unearthed. But today, come on. The ISM yesterday printed a 201-month high. I mean, new orders was at 64. The numbers are ripping, in terms of rate of change. And I guess that's what it is with a lot of these people, Jim. They don't do rate of change. They don't do the secret to the universe. They don't
Right.
they do levels, they do dogma, they do valuation.
And they get caught up, but you're right, they get caught up in dogma. Look, I am a complete believer in the idea that demographics, technology, and globalization, hopefully we still have some of it, is going to hold down the level of inflation. And
Right.
it has. That's why I'm looking for 2.5% inflation and not 10 as well. But like I've said, the problem is the whole bond market is structured on the idea that there will never, ever be inflation, even 2.5% ever again. So if you get even that level of inflation, while you could correctly say, well, that's not a big deal, can be for the bond market as well, because there are players that are not positioned that what happens to your portfolio if we go to 2.5% inflation and we stay there and the 10-year yield goes to 3? The answer is my portfolio is just not ready for that.
That's the problem. Guys, show theme number 3 that we introduced at the beginning of the year. Like, my only short idea was to be long the bubble of duration and deflation expectations, which a lot of portfolios, particularly pension funds, have been riding for a very long time. I mean, I was long it up until obviously November myself. So it's not like short deflation duration. That's actually when people talk about, and the rest of the queue, by the way, there's a lot of questions in here that have to do with like, okay, it's a bubble. When does it start to implode, Jim? And this bubble's already imploding. Why aren't more people into selling calls or buying puts in GLD, TLT? Yeah, you and me. You could put anything duration on the short side of your portfolio right now, and you're already capitalizing on a bubble imploding.
Yeah, I mean, I think the questions in the queue, if it is a bubble, why isn't it imploding? I think they're asking about the stock market.
Stock market, exactly. Yeah.
We haven't talked a lot about the stock market on this call because the bubble it's not there directly. The Fed's not buying stocks. It's in everything else to give the stock market the ability to go. And so I think you're right that, when it starts imploding is you look at, what's happening in the commodity markets, you look at what's happening in the currency markets, you look at what's happening in the fixed income markets. And when those markets start to get uneasy and queasy, and they're beginning to, you got 10-year highs across a lot of industrial commodities, you got interest rates rising, but they're not at the chaotic levels. It's when all the problems in those markets build up that you'll start to see it in the equity market as well. This is not directly per se in the equity market. It's kind of in everything else. Like I said, the Fed the Fed isn't buying SPY. The Fed is buying, treasuries, and they're keeping those rates at very low levels.
Yeah.
You don't think they're buying SPY.
Exactly. Well, this question's kind of funny, and it has to do with stocks at least. Jim, do you think you're going to be pumping the Portnoy ETF? That's a serious question from Santa Barbara.
Yeah, so anybody who doesn't know, Dave Portnoy came out today and announced that there's a new ETF coming Thursday with the ticker BUZZ, B-U-Z-Z.
Oh, really?
Yes. He's sponsoring it. He's sponsoring it. This just came out a couple hours ago. He's sponsoring it. It's going to scrape social media. It's going to buy the 75 largest stocks that are being hyped on social media that have a market cap of over $5 billion. Now, we've had this exact ETF out there before, and it delisted because it didn't work as well. But now we've got Portnoy associated with it too. It'll be interesting to see if this works. And Keith, can I throw out a little quick tangent? One of the things that they noticed about stocks being hyped is he's one of the biggest hyper of stocks, and he owns a lot of Penn Gaming. His whole net worth is tied up in Penn Gaming. Be very careful, Davey Day Trader. You start pumping Penn Gaming, and then this ETF starts buying Penn Gaming. If I could be so crude, the SEC is going to give you a nice anal exam if you're not careful about something. You can't be pumping your own stock when you've got a fund like this now. It's a whole different game.
I think you like it. I love it. I love the fact that we're showing him like this right now. Like, I think that this is great. Because what this does is it gives momentum as a factor. Like what you just said explained to me, I think that's unadulterated momentum ETF. That's what they should call BUZZ. And momentum is a factor. Momentum has had an ability, this year in particular, momentum in big, long, again, guys, show the factor exposures that have been working this year, and they work in quad 2, as I mentioned, high beta, high short interest. These are factors, low quality or high debt to enterprise value. Like, look at the returns on these on a 1-month basis alone, Jim. I mean, this drives the fundamentalist pig on Wall Street at the local hedge fund that has the same position as the other one, and then they all commiserate and talk to each other and cry about it. It's like, this drives them crazy, and I love it because it makes Portnoy look like he actually knows what he's doing, even if he doesn't know quite specifically why, and they don't, because their score is, like you said, if you're down 18 this year, that's pretty bad. You're not going to be able to do this for much longer.
Yeah, exactly. You know, I tweeted out about his and my comment was, it sounds like what this buzz is going to be is a high beta SPY. So when the market goes up, it'll knock the doors off the market. But when it turns around and it goes down, look out. I mean, so you're basically, but you could buy the S&P, buy SPY in a margin account, or you could buy Buzz, and it's kind of going to be the same thing.
Well, it actually is similar in construction, like with momentum as the main factor exposure, and is right. ARC has that. Cathie Wood's got momentum, but she really has ideas, right? Her whole model is to pitch the narrative, and if the narrative gains momentum, then people chase that. But Portnoy, what I like about the Buzz is that it could have GameStop in there, and it should have GameSop in there. Because it's buzzing. It doesn't mean that it's like Cathie Wood's great, next coming, second coming in my Irish Catholic faith. I'd love to see the second coming of Christ. I mean, but it's like I don't have to believe that with the Buzz, because the Buzz is just literally algorithmically taking what the crowd thinks they should be buying, which is great.
Right, exactly. They're just, all they're doing is it's an algorithmic fund. It just scrapes through social media, and whichever's got the most buzz, it owns. But like I said, Davey, be careful, man, because if you're creating those 75 stocks that you personally are creating those 75 stocks, and you personally create Penn to be one of those 75 stocks, you're going to have a big problem.
You should give we should have an inverse ETF for Dave, and maybe you should launch it. So we call it the Enema Fund or something like that. With the ticker's DOC or something. I don't know, but. Reality. This is what happens when you have growth and inflation accelerating to the highest levels since World War II. I mean, these are the kinds of things that happen. I guess last question on that is, like, does this get you excited? Like, are you happy about, you obviously should be happy about and proud about the call that you've been riding for a while here, but like just in terms of what you and I do every day, like, are you happy, you sad, you glad, you irritated, anxious, what?
I'm very happy because of two things. One, just to put the Buzz thing to bed, everybody's screaming at me, oh, this has got to be the top if he's coming out with Buzz. And I'm like, only if it's wildly successful could you actually argue that this would be the top. Let's check back a month to see how many people actually buy this thing and how much traction it actually gets at that point to see if this is wildly successful. But to write this larger, I love the democratization that's been going on Wall Street. Are there problems in the Reddit community? Sure. And there's problems in the Wall Street community. But what's happened now is the retail investors realize I got zero commissions, I can buy fractional shares, I've got all the information that everybody else has. I may not have the experience or the time to disseminate it like an army of analysts has, but they don't have anything over me in terms of information. It's all on the internet, so we can get it. So scalability is not a problem. I could buy fractional shares. Price is not a problem. I've got zero commissions, and I can go out and do it myself. And then I've got a big network effect with all the social media. There's influencers out on Reddit, and then you follow the influencers. Hell, Wall Street's done that for 50 years. While Warren Buffett publishes his portfolio, and all these seven-figure analysts go, well, we got to buy that because Warren owns it. And it's the same thing as what's going on Reddit as well too. So to allow the public to have more choices like that, I think is just tremendous. Sure, is it a little bit overdone? Probably, and it'll pull back. But those old men shaking their fist at progress, thinking that it's going to go 100% go away, that it will never do. This is a new era. There's a new retail resurgence in the market. Yeah, it's a little bit overhyped now, but retail is not going to go away. not if you keep with fractional shares and zero commissions and all of the networking that you have with social media to learn and understand what's going on.
Well, the only way, and you appropriately said it, that some things can go away is due to some gargantuan SEC violations. So for those of you that are getting a little too ahead of yourself, a little over your skis, be very careful. That was very good advice by a veteran, a wily veteran who's nailed it to Mr. Portnoy, who is not a veteran yet. And that was awesome. I love it. I agree with you 100%, or I'd say so otherwise. I mean, what a great part of American history for markets to have a lot more people participating. Again, it's not about being overbought, bubbly, oversold, crashing, whatever. It's actually giving people an opportunity to be mobile and actually make some money or save some money or learn from losing money, all that. That's great. I think it's awesome. So,
and having skin in the game, they're having skin in the game, that the economy isn't just this outsider thing that has no impact on me, that this stuff matters to me. I want the economy to do better, and I don't want it to do worse. I mean, the worst thing we could do with the economy is not have people involved in the markets and just mail them money every week. So this is kind of somewhat of the opposite of that, although I know those two things are somewhat interrelated right now, which makes it a difficult period.
I love it. Well, thanks for helping perpetuate the democratization of it all, because I know a lot of people are really happy about that. And thanks for spending the time. I appreciate it.
Sure, thank you.
He is Jim Bianco. That was awesome. The guy's got passion. You got to have passion when you play this game. Thanks for joining us.